This is Quint Bilo with introductory comments on cost, volume, profit. This chapter represents a radical departure from the model of cost accounting where we focused on manufacturing costs in the plant or product costs, keeping separate any cost outside the plant known as period costs. Whether a cost is product related or period related, this chapter introduces us to looking at how any and all costs behave. So it abandons the product period cost distinction and introduces us to a variable versus fixed cost contrast. I want to focus on this new cost distinction first before we get into the cost, volume, profit formula calculations themselves. We'll first fully define what we mean by variable and fixed costs, and a cost in the middle, mixed costs, in the meaning of a range of operating capacity that will concern us, known as the relevant range. Cost behavior, as noted, is the study of how specific costs respond to changes in a level of business activity. Some costs change, we call them variable. Other costs remain the same, irrespective of the change in business activity, and we call them fixed. This distinction helps management plan operations and decide between alternative courses of action. So our starting point is measuring key business activities. Activity levels may be expressed in different terms: sales dollars, miles driven, rooms occupancy, dance classes taught, etc. Many companies use more than one measurement base. In our initial problems, we'll pick any particular base. Later on, though, we'll be concentrating on changes in sales dollars. So the changes in the level or volume of activity should be correlated with changes in total costs. This is what allows our costs to be classified as variable, fixed, or mixed cost. Here's a watch out. We'll also be talking about cost in terms of dollars per unit and not total costs. Let's define variable costs. They are costs that vary in total, directly and proportionately, with changes in the activity level. For example, if the activity level increases 10%, total variable costs increase 10%. Likewise, if the activity level decreases by 25%, total variable cost will decrease by 25%, a proportionate change. What if we express those same variable costs that change with an activity level on a per unit basis with that activity base? Now, from this perspective, variable costs remain the same per unit at every level of activity. It's the per unit calculation that demonstrates that the total cost will rise or fall as activity rises or falls. So, variable costs do not get their name from their per unit behavior, but rather from the total incurred cost perspective. Let's look at a graph of variable cost as the activity level increases. Activity level here is defined as the production of a tablet computer, which contains a camera. We are mapping the costs incurred for that camera part. This is an example of a direct material cost. At zero production, as graphed on the x-axis, the cost on the y-axis is, of course, zero. As production rises to 2,000 tablets, we can read a camera cost of $20,000 for that part. And as production rises to 10,000 tablets, we read a camera cost of $100,000 on the y-axis. The camera cost incurred in total is directly proportional to the number of tablet computers produced. What makes this the case? On a per unit basis, the direct material cost of the camera unit is $10 per unit. A constant per unit cost of the direct material causes the total camera cost to rise as production increases. Straightforward logic. Graph B shows us the per unit cost of this direct material at every stage of production activity. It's constant per unit. $10 per camera for the first tablet produced, and the same unit cost for the last tablet produced. Placing these two graphs side by side, we see on the left that total cost increase directly as production increases. Because on the right, the per unit cost of this material is $10 per tablet computer produced. A variable cost gets its definition from the total costs incurred as the defined activity unit changes. Let's change our focus to fixed costs. Fixed costs are total costs that remain the same in total regardless of changes in the activity level. Fixed cost per unit, though, varies inversely with activity. That is, as volume increases, unit costs decline and vice versa. Examples of fixed costs: property taxes per year, insurance, rent, depreciation on buildings and equipment. These are all fixed costs irrespective of the change in the level of activity, such as production. Here's an example. The Damon Company leases its production facilities at a cost of $10,000 per month. Total fixed costs of the facilities will remain constant at every level of activity, as this graph shows. Whether we produce 0 tablets or produce 10,000 tablets, our rent cost is $10,000 per month, fixed in total. Looking at the same cost on a per unit basis, the cost on a per unit basis will decrease as activity or production increases. In our example here, at 2,000 units of production, the unit cost per tablet is $5. $10,000 divided by 2,000 units. When the company produces 10,000 tablets, however, the unit cost of that fixed rent is only $1. $10,000 of rent divided by $10,000 of production. So our cost curve slopes downward as we're more efficiently making use of our fixed cost as we produce more units. Placing our total fixed cost and fixed cost per unit side by side, we see that our total fixed costs remain constant no matter what level of production on the left. That's where fixed costs gets their name, based on total cost behavior, not per unit behavior as you see on the right. The right shows per unit behavior decreasing as our production increases because we're more efficient at producing more for the same fixed cost. Review question. Variable costs are costs that both A and B, they varied in total directly and proportionally with changes in activity level, and the variable costs remain the same per unit at every activity level. Let's discuss the meaning of relevant range. When we're talking of relevant range, a company can operate their capacity at various ranges from 0 to 100%. Now, throughout the range of all possible levels of activity, a straight line relationship usually does not exist for either variable or fixed costs. But the relevant range concept will allow us to narrow the expected activity level that a company can operate in. So just a caution in practice that the relationship between variable costs and changes in activity level is often curvilinear, not a direct straight line. Similarly, for fixed costs, the relationship is also a nonlinear. Some fixed costs will not change over the entire range of activities, while other fixed costs may change a lot. These graphs show us the behavior of total variable costs on the left and total fixed costs on the right over a wide range of production, from producing nothing to producing 100% at capacity. On the left, the total variable costs are increasing, but they're not increasing at a directly proportional rate. It's curvilinear. Likewise, the fixed costs on the right, they're fixed for a range of activity, but then they tend to step up when the range of activity increases dramatically. So variable costs are even subject to some variability. They're not precisely proportional in practice. And fixed costs will tend to step up as the activity level increases significantly. So let's narrow this range of possible operating activity. The plant can operate at 0 or 100% capacity, as indicated on the x-axis on the bottom. But we'll make an assumption that the plant will operate between 40 and 80% of its plant capacity. That becomes our defined relevant range, the range of activity for which a company expects to operate during the next year. Within this narrower relevant range, we can see the variable costs on the left approach a rather straight line, and that our fixed costs on the right during that relevant range are constant at the middle bar level, not expected to change at the relevant range of activity. Review question. The relevant range is the range over which the company expects to operate during a year. Not all possible capacity levels, but that which they expect to operate at. Let's move our attention to a concept called mixed costs. These are costs that contain both a fixed cost component and a variable cost component. They change in total, but not proportionately with changes in activity level. Let's look at this graph of a mixed cost on the right. So it has a fixed cost element at the bottom. In this case, $50,000 a month are fixed costs, but then it has a variable element that increases as miles are driven in this case. And so our total cost is a combination of the fixed element at the bottom and the variable cost element at the top. Here's an example. A cleaning company reports the following total costs at two different levels of production: 10,000 unit level of production and a 20,000 unit level of production. Let's classify each cost as a variable cost, a fixed cost, or a mixed cost. Looking at direct materials cost first, at 10,000 units we spend $20,000. At 20,000 units of production we spend $40,000 units. That's a directly proportional cost as production increases. So direct materials is a variable cost. Likewise, look at direct labor. It goes from $17,000 at 10,000 units of production to $34,000 at 20,000 units of production. It increases directly. That's a variable cost, direct labor. Similarly, indirect materials increases from $1,000 to $2,000 as production doubles. That would be a variable cost, directly proportional to the activity base. The cost doubles as the activity doubles. Now take a look at the depreciation expense. $4,000 when we produce 10,000 units, and it stays at $4,000 in total when we produce 20,000 units. That'd be an example of a fixed cost. Similarly, rent, $6,000, and no matter what level of production, a fixed cost. So fixed costs do not change when the production level changes. Now let's take a look at an example at maintenance costs. They increase from $8,000 to $10,000 as production doubled. So it's an increase, but it's not a proportionately direct increase. That'd be an example of a mixed cost. Similarly, utilities, they increase from $3,000 to $5,000 when production doubles. That'd be an example of a mixed cost. It has a fixed cost element plus a variable cost element. It changes, but doesn't change proportionately as the activity level changes. Let's look at a method that allows us to isolate each component of a mixed cost. The high-low method uses the total costs incurred at the high and low levels of activity to classify mixed costs into their fixed and variable components. The difference in cost between the high and low levels represents the variable cost, since only the variable cost element can change as the activity level changes. Here's the formula. We should go after the variable cost element first. We determine that variable cost per unit using the following formula. A change in total costs from the high level versus the low level divided by the high level of activity versus the low level of activity change gives us our total variable cost per unit. Let's look at an example. We have to look at our data first. And the graph below shows our total miles driven and our total cost operating a fleet of buses during these time periods. Scanning the total cost here, we see that we have a low level of $30,000 per month in January and a high level of $63,000 per month in April. That's our high and low point. So we take the difference between the high and low point, $63,000 minus $30,000, a $33,000 change, and we divide that by the difference in activity levels, 50,000 miles minus 20,000 miles, or 30,000 miles difference, give us our $1.10 cost per unit. This forces out our variable cost component. This is what's changed. Then in the second step, we'll back into the fixed cost component of that mixed cost. So we determine the fixed cost by subtracting the total variable cost at either the high or low level of activity from the total cost at that level of activity. So we start with the variable cost first. At the high level of activity, representing 50,000 miles driven, $1.10 variable cost, $55,000, subtract from $63,000 gives us an $8,000 fixed cost component. Likewise, we can do the same thing at the low level of costs. 20,000 miles times $1.10 variable, $22,000, subtract from $30,000 gives us the same $8,000 fixed level. So the high-low method first concentrates on calculating the variable cost and backing into the fixed costs. Let's do an example. Let's work out an example with the formula we just developed. Maintenance costs are $8,000 per month fixed plus $1.10 per mile driven, represented by our following formula. $8,000 fixed plus $1.10 per mile is driven. So at 45,000 miles, we can estimate our maintenance cost in total will be fixed, $8,000. They won't change. Variable, $1.10 times 45,000 miles, $49,500, for a total mixed cost predicted of $57,500 at 45,000 miles driven. The fixed remains the same. The variable element we must calculate. Here's a graph of taking all our observed costs of our mixed costs over various levels of production from 0 miles to 60,000 miles. And if we join the top right-hand cost with the bottom one, we get our formula for predicting mixed costs. Actual experience, of course, will flutter, but joining the high and the low gives us our formula we just worked in the previous problem. Question. Mixed cost consists of a variable cost element and a fixed cost element. Let's do an example of the mixed cost element isolating the variable and fixed cost elements. Burns has the following data. Various costs for the month of March through July with various units produced. Let's compute both the variable and fixed cost elements using the high-low method. And then we'll estimate the total cost if the company produces 6,000 units. So first, let's look at our high-cost month, March, $14,740. Search out our low-cost month, May of $11,100. And let's compute the variable costs related to this. $14,740 minus $11,100, the change in cost level based on high versus low, and divide that by the change in units, 9,800 at the high level, 7,000 units at low level, yields $1.30 per unit variable costs. What's our fixed costs? We'll take our total cost at the high level, $14,740. We'll subtract out a calculation of our variable cost element that is $1.30 times 9,800 units. That forces out our fixed cost of $2,000. We can make the same calculation at the lower level using $11,100 in total, backing out the variable cost element of $9,100, which is $1.30 times 7,000 units at that lower level, forces out the same fixed cost of $2,000. Now let's estimate this total mixed cost if the company produces 6,000 units. What was our fixed element? $2,000. Our variable element, $1.30 per unit times 6,000 units, $7,800. Total mixed cost, $9,800 using the high-low formula. The fixed element and calculating the variable cost element. Total calculated cost for producing 6,000 units.